I wanted to talk today about two different high momentum ETFs. In fact, one of them is literally called the S&P 500 Momentum ETF. And funds like these ones, especially with the market that we've been in for the past couple of years now, have become increasingly popular. And I do know that we've recently seen a pullback in the markets, and a lot of those high growth, high momentum stocks have fallen pretty significantly as of the past month or so. But if you ask me, as someone who is very bullish long-term on the stock market, I'd say right now may be a great time to buy shares of these growth and momentum ETFs. So with that, I wanted to start with an ETF that one of you actually brought up to me recently, and I hadn't heard about it before. It's CHAT, or the Roundhill Generative AI and Technology ETF. Now, the reason why I consider this a high momentum growth ETF is mainly because, as we know, the AI and tech sector has been just rapidly growing over the past 3 years or so now, and will potentially continue growing for years to come. And the growth this year for this ETF is definitely no joke. It's at 41% year to date, and that's even after this recent pullback that we've had. At one point it was up 60% year to date, and from the April lows of this year, it's up 85%. And the reason for all this growth is because inside its portfolio, you'll find a lot of those hyperscaler companies like Google, Nvidia, Broadcom, and Microsoft. Now, keep in mind, it is a very concentrated portfolio though, with only 46 different holdings, with a 72% weighting towards the technology sector, which really means you're sacrificing a lot of diversification among different sectors, but the trade-off is you're going to open the door to a lot of potential growth. Now, if you're someone that does care a lot about fees, the expense ratio is not that great. It's at 0.75%, so a lot higher than average, but with all that rapid growth that you get, especially during a bull market, the expenses may totally be worth it. Now, CHAT is a pretty new ETF. It's only about 3 years old at this point, with less than $1 billion in net assets, but definitely one to explore if you're seeking that rapid growth from a concentrated tech and AI portfolio. This takes me to SPMO, which is a lot less concentrated, but still focused on fast-growing hyperscaler companies. Now, what I like about SPMO is there's not as much concentration on the tech sector. As you can see, it only makes up about 35% of the portfolio, with companies like Walmart and JP Chase in the top 10 holdings. So not all tech in the top 10. Now, with slightly more diversification comes slightly less growth, especially compared to the CHAT ETF, but year to date, it's still up 20%, outperforming both the S&P 500 and the NASDAQ. So SPMO is essentially a growth ETF that tracks the S&P 500 Momentum Index, where they take 100 companies out of the 500 that have been growing consistently over a 12-month period. It also takes into account risk-adjusted momentum as well. That way there's not too many stocks in the portfolio that experience crazy volatility. So as someone who, again, is very bullish long-term on the S&P 500, I absolutely love ETFs like this because it holds a lot of those rock-solid, fast-growing companies that are also not too high beta. So even though both these ETFs are considered high momentum, they're actually fairly different when it comes to their holdings. There's only about a 20% overlap, meaning only 13% of CHAT's holdings are also in SPMO's portfolio. So you could definitely hold both of these ETFs in your own portfolio and not have too much overlap that way. So I'm definitely a huge fan of these high momentum growth ETFs, but let me know what you think of these two funds, and I will see you all next time.